Good evening. In the intricate, interconnected world of global finance, a palpable tension has settled over the major currency markets. The very foundations of international trade and investment are being tested, as the US dollar, the British pound, and the euro find themselves on a precarious edge. At the heart of this global anxiety lies a familiar, yet increasingly disruptive, force: the escalating use of tariffs. This isn't merely about exchange rates, it's about the stability of economies, the flow of goods, and the confidence of investors worldwide. Tonight, we delve into how these three titans of the currency world are navigating a landscape increasingly shadowed by protectionism. Let's begin with the US dollar, often considered the bedrock of the global financial system. For decades, its status as the world's primary reserve currency has provided it with immense strength and stability. In times of global uncertainty, capital traditionally flows into the dollar, seeking a safe haven. This phenomenon has, at times, led to a stronger dollar even amidst domestic economic challenges, as investors prioritize safety over yield. However, the dollar's recent trajectory has been complex. While still robust, it faces pressures from domestic inflation, the Federal Reserve's ongoing monetary policy decisions, particularly interest rate hikes or cuts, and, crucially, the U.S. government's aggressive stance on trade. When the U.S. imposes tariffs on imports, it fundamentally alters the cost of goods. For American consumers, imports become more expensive, potentially leading to higher inflation. For foreign exporters, their goods become less competitive in the U.S. market, impacting their revenues. The direct impact of tariffs on the dollar can be multifaceted. Initially, a strong dollar can make U.S. exports more expensive, potentially leading to a trade deficit. However, if tariffs are seen as a tool to protect domestic industries and bring manufacturing back home, some might argue for a long-term strengthening effect. More often, the threat of tariffs, and the subsequent retaliatory measures, introduce immense uncertainty. This uncertainty can trigger a flight to safety, paradoxically strengthening the dollar as global investors seek refuge, even if the underlying trade policies are detrimental to global growth. The dollar, in essence, becomes a barometer of global anxiety, rising when the world feels more volatile. Shifting across the Atlantic, the British pound has been a poster child for volatility in recent years. Still reeling from the economic complexities of Brexit, the UK economy has faced a unique set of challenges, including persistent inflation, slower growth, and a tight labor market. These internal pressures alone would be enough to keep the pound on edge. Now, layer on the impact of tariffs. For a highly trade-dependent economy like the UK, tariffs, whether imposed by the US, the European Union, or other major trading partners, represent a direct threat. If U.S. tariffs target key British exports, such as luxury goods, automotive components, or specialized machinery, British companies face reduced demand in a crucial market. This directly impacts their profitability, potentially leading to job losses and a weakening of the overall UK economy. A weaker economy, in turn, typically translates to a weaker pound, as investor confidence wanes. Furthermore, the risk of retaliatory tariffs from the EU or other nations, in response to US protectionism, places the UK in a precarious position. As a non-EU member, the UK must navigate its own trade agreements, and any global trade war fueled by tariffs could disproportionately affect its ability to forge new, favorable deals. The pound's sensitivity to these external trade shocks makes it particularly vulnerable in the current climate, reflecting the market's deep concerns about the UK's economic future. Finally, we turn to the euro, the currency shared by 20 nations across the European Union. The Eurozone is a vast and diverse economic bloc, with member states exhibiting varying levels of economic strength and fiscal discipline. This inherent diversity can be both a strength and a weakness, as synchronized monetary policy by the European Central Bank, ECB, must cater to a wide array of national economic realities. The euro, like the pound, is highly susceptible to external trade shocks, particularly from the US. If the US imposes tariffs on key European exports, think automobiles, agricultural products, or specialized industrial goods, it directly hurts the export-driven economies of countries like Germany, France, and Italy. This reduction in export revenue can slow down economic growth across the Eurozone, leading to concerns about recession and, consequently, a weaker euro. The threat of a full-blown trade war, initiated by tariffs, introduces significant uncertainty for European businesses and investors. Companies might delay investment decisions, reduce production, or seek to diversify their supply chains away from affected regions. This collective anxiety can lead to capital outflow from the Eurozone, further depressing the euro's value. The ECB's challenge is immense: how to manage inflation while also supporting economic growth in the face of external trade pressures. The euro's value, therefore, becomes a reflection of the Eurozone's collective resilience against these external economic headwinds and its ability to maintain internal cohesion. The tariff factor is not just about direct costs, it's about the erosion of trust in the global trading system. Tariffs are designed to protect domestic industries, but they often invite retaliatory measures, spiraling into trade wars that harm all participants. This cycle of protectionism disrupts established supply chains, increases production costs, and ultimately leads to higher prices for consumers, a phenomenon known as tariff-induced inflation. Businesses struggle with uncertainty, leading to reduced investment and hiring. The International Monetary Fund and other global bodies have repeatedly warned that a widespread tariff regime could significantly dampen global economic growth, potentially even triggering a recession. The interconnectedness of these major currencies means that the struggles of one can quickly cascade to others. A weaker euro might make U.S. exports more competitive but could also signal broader global economic weakness, ultimately impacting the dollar. A volatile pound adds to the overall sense of uncertainty, making investors more cautious across all markets. Emerging economies, heavily reliant on global trade and stable major currencies, are particularly vulnerable to these shifts, facing higher borrowing costs and reduced demand for their exports. In conclusion, the global currency landscape is indeed on edge. The U.S. dollar, the British pound, and the euro are all navigating a complex web of domestic economic challenges and, critically, the disruptive force of tariffs. This era of heightened protectionism introduces a level of unpredictability that financial markets abhor. The question for policymakers, businesses, and indeed, every global citizen, is how long this tightrope walk can continue before a misstep sends ripples, or even shockwaves, across the entire global economy. The stability of our financial future may well depend on finding a path back to open, predictable trade.